Hello and welcome to Securities Lending Saturday. I'm Roy Zimmerhansl and I'm your host today. Today, we're going to be talking about transparency as it relates to securities lending. We talked about trading last week. This week, we're going to be covering everything except trading, and it's a big universe. So, thanks very much for joining me. And if securities lending is your thing, you're a borrower, a lender, an intermediary, part of the ecosystem, or just plain interested in securities lending, then this is the place for you. So let's get to it. Hello, everyone. As I said, this week we're going to be talking about transparency in the non-trading securities lending space. This is part 2 of transparency as it relates to securities lending. So without further ado, let's just get started. So these are the previous 28 weeks. Today we're talking about transparency in a non-trading sense. Next week, we're going to be talking about fair distribution and how those things get allocated. So if you have multiple lenders with the same positions, how do you decide who gets that loan? That video is a suggestion from one of my loyal viewers. So thanks very much, Amel. Really appreciate you paying attention to this and giving me suggestions for several. So thanks for that. And I look forward to answering any questions that people have. As always, if you have ideas or suggestions on topics you'd like to see, put them in the comments below. Give us a like if these shows help, and get the information across that help you understand more or do your job better. Okay, we're going to be talking about 4 different aspects of transparency today. First of all, voting, then collateral, then taxes, and then fees. Each of these has a different aspect of transparency to them. They all have different angles. Transparency, remember, is something that in the post global financial crisis, that regulators seem to have jumped on as a panacea to solve any problem that you could ever come up with. That's not my view. I think there's strengths, there's weaknesses, and most of all, I think transparency can sometimes lead to misunderstanding and bad interpretations. Hopefully, we'll go through that and you'll understand a little bit more about what I mean as we go through it. As always, if you like these videos, give us a like, a thumbs up, a subscribe. Remember, we're still trying to get to 500. I think we have another 130 to go. So we're at 370 at the moment. But as soon as we get to 500, it will open up the community channel where I'll be able to answer more questions and share even more content with you guys for free. So look, I'm really keen to get there. If you want to be able to share your own views, ask questions, and get answers, then help me get some more subscribers. The minimum now is 500 to get the community channel turned on, and I'd love your help to do that. Let's get back to it. So, voting. We're going to follow the same pattern throughout. And in fact, it looks like my picture is just obscuring things a little bit. So I might just not share that way. Let's look at it this way. Okay. A better layout, hopefully. So first of all, voting, you have to understand that no matter what anyone tells you, stocks that are on loan cannot be voted, period. That's just the way it is. And don't try to think that there's a way around it. There isn't. People have been looking for forever. So if a stock is on loan, think about it. Usually, as we say, the loans are made to satisfy the delivery obligations of either a short sale or a failed trade. Those shares go from the investor through the intermediary process to whoever that end taker is, whether that's a buyer on the short seller side or a receiver if it's a failed delivery. Anyway, they have the shares. It's registered in their name, and they will be the ones that have the ability to vote that share. So there's no other way around it. Now, so you have to assume that if stocks are on loan, they can't be voted. Now, of course, as we've been saying all the way along, one of the real benefits of securities lending is that it has flexibility built into it. So as an investor, you have the ability to lend out your stock, make some money from it. And if you decide that you want it back for whatever reason, you want to vote it, you want to sell it, you just want to sit on it, you're allowed to do that. And the borrower is required legally through the contracts to return it to you. So think about it that way. They have to give it back if you want it. So you always have that flexibility. And of course, that manifests itself most obviously when you want to vote. Now, that throws up an issue for investors. They have to decide whether voting that share is more important than generating revenue from it through lending. And there will be times when that is the case. There will be times when that isn't the case. And of course, there's also people that have overriding standing instructions where they say, never recall my shares for a vote. And some other investors who say, always recall my shares for a vote. And something like that is very commonplace in a country like Japan, where Japanese domestic investors always want their shares voted. Okay, so they always want to get them back. That creates opportunities for non-Japanese lenders to lend their stock out. And every voting period, we see Japanese investors swapping out for foreign investors in terms of supply, the assets available for loan. So that's pretty standard in not just Japan, but Japan's the best example of it. And it's my prediction that in fact, this will become more commonplace as we see ESG making a huge impact on investors going forward. I think there's every possibility that we'll see a Japan-like market develop for some investors who say, I'm happy to make my securities available for loan, but I always want to get them back so I can vote them. And again, that might create a two-tier pricing system. Anyway, let's just get back to the slides. I'll talk more about that in a couple of minutes. Now, the second point here, asset managers, without a shadow of a doubt, are under more pressure to disclose how they have been voting their shares. Forget about lending, just as investment managers, even positions that are long and in the box. So there's more scrutiny, more pressure. Investors are demanding more, like their customers are demanding asset managers disclose it. Regulators are asking about it. And certainly the SEC has it very much on their agenda that it's something that they want to see. So no question that asset managers will be voting more frequently. And the problem with that, of course, is that recalling stock is disruptive to borrowers, right? They have a trade outstanding. They've got a short position in the market. They borrowed the shares. They're paying their money. And then all of a sudden, here comes this investor who wants to get those shares returned to them. That's not great. That's disruptive, as I say. They want continuity of that short position. And that's very much what the prime broker's role is, to make certain that if that prime broker gets recalled, well, that shouldn't affect their underlying clients. So they're always looking for other sources of supply. And that's why, in the first place, they may discriminate against lenders that have a history of voting and recalling their shares. And of course, the agent lender, before you get a recall that goes to the prime broker, they're also trying to make certain that there's stability and continuity for the prime broker. So that's why many people think large agent lenders have an advantage over smaller ones, because they typically will have more depth of supply. Investor A wants to recall their shares because they want to vote, or they've sold it. There's always investor B there. So that's one of the advantages that large agent lenders have. Of course, the flip side to that is, because they're large, more borrowers come to them. And I think to an extent, there's a little bit of a leveling there. But there's no question that larger investors, larger agent lenders have better breadth in the types of customers that they might have, because you might have an active investor alongside a passive investor that actually has to hold the shares and may not be as active in terms of voting. Okay. The other thing from an agent lender, of course, if they're having to substitute assets or even recall the prime broker, that's not good for their own reputation, but it also adds a layer of expense. So there's no question that recalls can be disruptive, but they are a fact in the market. And that's why there's no real solution to them. More active voting, as I say, is inevitable. It's a regulatory requirement. And if it's not a regulatory requirement, it will be an intermediaries requirement or an end investor requirement that actually says you must vote. You must vote more frequently, and you must disclose how you vote and when you vote, or by implication, when you don't vote, because we're going to be keeping an eye on you to see whether you are practicing good stewardship. Okay. So to me, that's a big challenge for the intermediaries. So I think they really need to make certain that they take note of it and develop it. Now, the reality is, and the good news is that technology enables this, right? We have technology today that can identify that, first of all, that investors want to vote more actively, that it gets translated to the agent lenders, that the agent lenders find other supply sources, or failing that, that the prime brokers do as well. And so the bottom line here is that asset managers are going to be actively voting more frequently going forward, and everyone just has to find a way to cope with that. Okay, so that's voting. I'm not going to take the mandatory Coke break, but I will mute so you don't have to hear it. And because I'm not on camera, you don't have to see it. So just give me a minute. It's pretty weird. I do some voice exercises before I start these things, but inevitably my throat gives out really quickly sometimes. Okay, so that's voting. Part two, collateral. Now, collateral, again, forget about securities lending. Collateral is just becoming pervasive, whether that is outright investing and exposures that you might actually carry and the fails that are actually in the marketplace. So if you go back to GameStop, the reason that Robinhood stopped their investing clients from buying shares, they say, is because they ran out of collateral to give to the depository for clearing. So that was just cash clearing activity. If you look at securities lending, if you look at repo, if you look at derivatives, whether they're cleared derivatives or bilateral uncleared derivatives, collateral is all over the place. Add in things like collateralized reinsurance. I mentioned repo. Everything is becoming collateralized these days. And so collateral is central to the investment landscape. Now, the key thing here and the relevance of this point is that the lending investor, the collateral receiver, owns the collateral. Okay. Remember, legally, when they lend out stocks or bonds, they transfer ownership to the borrower, who can do whatever they like with those shares. They can do nothing. They can sell them. They can re-lend them. They can print them off and use them as wallpaper, as I say often. Okay, so they own it. Similarly, if when the lender receives the collateral, that is theirs. That becomes their asset until the exchange at the end of the transaction, or adjusted with mark-to-market changes. Now, the only exception to that is, as it says right here, if you can see my cursor, if the loan's done under a pledge agreement, the investor takes possession of the collateral, but they don't take ownership unless there's a borrower default. But again, that's at the moment a minority of cross-border securities lending transactions, but just be aware of that. So what are the key issues here? Number one, if an investor or lender is going to become more selective about the collateral that they accept, that's a problem. Reducing the flexibility that a borrower has in dealing with a lender on collateral is challenging. That means that the universe of collateral is going to be, almost by definition, more expensive for the borrower and may disadvantage them. But of course, as a lender, I don't want to hold collateral I don't want to hold on to. There's a reason why I have a collateral policy and why I have selected collateral that is acceptable to me. So I might be willing to lose out on loans, but keep my collateral profile more narrow, because you have to go through both parties. They have to go through the selection process, the maintenance process, the adjustment process. There's a lot of day-to-day work in collateral maintenance. Now, of course, that's reduced where tri-party is used, and that'll be another future video that I do. But there's also quite a lot of bilateral collateral that still happens today. And as I said, when borrower flexibility is reduced, that means that A, they're less likely to borrow from you if you are a lender and too selective. And B, if they do end up borrowing from you, it will still mean that you don't get optimal fees, because the collateral that you will accept is a little bit more expensive for them. Okay. Now, one of the real trends here, I think that because of ESG concerns that is growing dramatically, Investors on the front end are very selective about which collateral they will receive and accept. And that needs to reflect, because they own it, it needs to reflect the same filters on the front end in terms of securities they could borrow. Let me phrase that a different way. If you think about an investor who's very concerned about ESG, and they say, we are willing to look at a universe of assets that's comprised of this, because we're going to own that asset and it has to meet our criteria. It would seem rather odd if they go through all the work on the front end of saying, this is what I am and am not going to accept. But then they say, but when I loan out the assets, I don't really care. I'll just take any old piece of crap. Because as I said a minute ago, that lender becomes the owner of that asset. So I see collateral that's tied to ESG filtering as being a super important trend going forward. And of course, that means it has implications as well. And the key thing here is that I think service providers need to innovate. They need to facilitate this kind of increasing client selectivity and make certain that they can operate on a cost-effective basis to meet both the investor requirements, but also make it as simple and straightforward for borrowers as possible. So I think service provider innovation is going to be one of the key battlegrounds in the coming years. Now, again, fortunately now, the solution to this is technology. Technology, the way I look at it is technology really is the thing that's enabling granularity. So, where you can get to the very specific individual client level. At the same time, while you're allowing clients to be more selective, the automation lying behind that should mean that the matching engines through tri-party agents or even sometimes bilaterally will also facilitate the ability to have low unit cost processing, because that's the challenge. And of course, the transparency angle that is that both the collateral policy and portfolio snapshots should really be available, particularly to pooled investors, right? Where there's not a lot of transparency at the moment. And if you go back, let me give you an example. In around, say, 10, 12 years ago, maybe even a little bit longer, there was a battle between ETFs, okay, in Europe, where ETFs that had the physical assets underlying them, they would lend those securities out or they would hold the portfolio and they would take collateral. And that was all pretty much invisible. And at the same time, the challenge was that for the synthetic backed ETFs, where rather than buy the assets, they were buying swap contracts. People were saying, oh, that's really scary because we don't know who this exposure is to. We don't know what collateral you're taking. We don't know what the terms are. And so what they did was those synthetic ETFs, they innovated and they started being the first ones to disclose the underlying collateral that was held on a daily basis, making it publicly available. And that set a whole new standard for the ETF industry. Now, of course, in the end, physical ETFs in Europe won out, although there's a bit of a resurgence there. So who knows where it will go. I think we'll have a universe of both, and that will carry on. But I can see the same kind of thing happening more frequently, more publicly, more accessibly, addressing this transparency issue for more lenders in the public domain. Okay, so that's my belief. Only time will tell. Turn to the third issue. It's about tax. So tax issues really are pervasive in securities lending, and they cover everything from capital gains tax. We're trying to avoid that because securities loans are temporary transactions. They're not sales, they're not acquisitions. So hopefully capital gains tax gets an exemption. If you look at the second point, we're talking about withholding taxes. So again, when an asset's on loan, the borrower has to make a cash payment equivalent to what the lender would have received had they not made a loan. And so if you suffer more withholding tax than I do, it's cheaper to borrow from you than it is to borrow from me. The third one is income tax. So if you are generating securities lending fees, are you paying tax on that? But importantly, sometimes as well, you need to make certain that in the domestic jurisdiction of the lending activity, that you're also not deemed to be doing business and subject to tax there. That was an issue that arises in a country, say Taiwan. Stamp duties have been a factor in the UK for many years, but it's not the only country where just moving securities back and forth would generate a tax liability. You end up processing transactions with a different code to say it's a securities lending transaction, not a sale or not an acquisition, and you can avoid paying those taxes that really shouldn't apply. But again, there's a process there. And as we go into more new markets, we need to always be aware of that. Final one there, financial transaction. That's again, one related to processing. And here again, it's an area where securities lending transactions, securities finance transactions generally can be exempt from these taxes, but it does come with reporting obligations. So again, there's lots of different taxes. Taxes are a complex area. Taxes are one of the hardest things to change when you get into a new market because the tax authorities and therefore the governments in these countries are really concerned about making special exemptions for taxation. Because one of the issues that they face is that when they make changes to tax regulations, it could have an impact on other tax streams of revenue that they have without realizing it. So they're very slow and very cautious to make those changes because of the scale and impact on other people. So, uh, financial transaction tax, stamp duties, withholding tax, all of these things are really super critical issues to resolve before you get into a new market. And the issues that they throw up, of course, first of all, the tax issues need to be clear. Doesn't mean that they need to be resolved. So sometimes you can go in to a new market without having a certain of how a tax authority would treat the transaction because it may be that there's enough revenue in there that you say even in a worst case scenario where I'm subject to tax, that'll be okay because I've made enough money. So you just need to understand which tax issues, where there's uncertainty, and then you can do an evaluation of whether it's worthwhile waiting until there's complete clarity or whether you're willing to take a chance because of the money that's on the table. Now, tax, of course, is money, and errors in your calculations, your processing, what you think your obligations are, what your trading criteria are, errors are expensive. So you need to be clear. The third point there, tax can be a differentiation. As I briefly mentioned a minute ago, since the borrower is having to replace the lender's dividend or interest payments on a net basis, what they're looking for generally, if they think a transaction will go over a dividend or interest period, is they want a lender that not only is stable, but also has the lowest withholding tax or the highest withholding tax and the lowest net payment requirement. Because if someone suffers 25% withholding tax and someone else suffers 15% withholding tax and someone else suffers zero withholding, the lowest payment I have to make is to the one that suffers the 25%. Because on a $100 payment, I'm only having to pay them $75. On a 85% requirement, I'm paying them $85. So $10 more expensive. And if they don't suffer any withholding tax at all, I have to pay $100 on $100. So that's very much part of the daily ebb and flow of the business. Now, I say that it can be a good thing and a bad thing. So if I suffer a lot of withholding tax, that's good for my securities lending revenue. Of course, the securities lending revenue is unlikely to ever go beyond the lost withholding tax. So frankly, if someone doesn't suffer any withholding tax, as an investor, they're better off. They're better off to suffer no withholding tax, miss out on securities lending revenue because they'll be ahead financially. So it's if your tax position is a bad one, that's good for lending. If your tax position is a good one, that's bad for lending. And then it gets down to just the contents of your specific portfolio. And just this final point here about market liquidity, that's the financial transaction tax reference. Like the reality is that there's no question that certainly in the early stages, Italy and France, who both put financial transaction taxes on their equity markets, suffered reduced liquidity as traders just avoided the market and went to other European markets or just avoided those markets overall and missed out on trades. So tax does impact markets. The solution is one area we always need expert advice. I can always tell you the kind of people that I've worked with over the years and make references there. I frequently have them as guests. Just let me know if you want introductions, because expert advice is worth its weight in gold on this. And of course, you need to balance your objectives, right? You need to understand the tax liabilities, you need to understand the income opportunities, and you need to determine what's important. And so here, clearly, you need to have collateral policies, you need to have portfolio snapshots that actually will provide information on what the withholding tax criteria is in the individual markets, so that your service provider always knows the right level to get, and that borrowers have clarity when they're actually borrowing the shares. The last point is on fees. And what I mean here is the fees that are generated from lending securities out. Now, here, the investor that lends their security typically shares in the gross revenues of the fees. So if something generates 50 basis points, it's about what's their proportion of the 50 basis points that they get to keep. So the fee split with their service provider, which is how it's usually structured, is based on a percentage of that gross number. And as part of the intermediary's share, the intermediary is typically making the loans, doing the day-to-day maintenance, doing the administration, settling the fees, doing all of the transaction work. Usually they absorb all of the costs out of their share of the revenue. Because if you think of it, the lending revenue and generally the risk should belong to the investor that loaned out that asset. And so what the agent is saying, yeah, but you can't do that without me. I do all this work for you. I'll absorb all the costs of doing that work. And that's how I justify my share of the fees. One thing to remember, though, of course, is that fee negotiations, as with anything, these are commercial arrangements. So you might have two investors with similar portfolios, both getting a securities lending service. But if one of them is twice the size of the other one, they're more likely to get a more favorable fee. Okay. So what looks like day-to-day similar service activity might generate different fee levels for the different customers because it's a transactional relationship. Now, there are other factors, and one of the problems that people face, investors, service providers, one of the problems that they all face is that there's very little transparency on fee splits for most lenders. Now, pockets of investors, usually public entities, where fee splits are disclosed and they're publicly available. Sometimes in the fund space as well, fee splits will be public, but generally they aren't public. And certainly for insurance companies, sovereign wealth funds, some of the big constituents, it just is never publicly disclosed. So no one really knows, other than getting multiple bids. You don't really know the arrangements are or what the likely arrangements are. And historically, many of the securities lending fee arrangements have been tied into larger relationships. So custody and clearing relationships, overall relationships. So they might do payments, they might do banking. So sometimes securities lending has been bundled in, and that means that the transparency on the amount that is paid for securities lending services is not always clear. Maybe they're overpaying, maybe they're underpaying, and it's subsidizing or being subsidized by some other activity. Okay, so that's a challenge. Now, the regulators here have really been discouraging, really across Europe, this kind of bundling approach, so that you need to have individual specified prices for individual services. And as a customer, I think that has a lot of merit, because I need to understand what I'm paying for, so that I can benchmark other service providers. And also so that if I decide to move part of my business, I know what that element might cost me. Now, there's other issues, and primarily these are how the commercial arrangements go. The portfolio compositions. Do I have great stocks that everyone's interested in borrowing, or are they main index stocks, which everybody else already has access to? The index benchmark, what I mean by that is a lot of investors follow MSCI. And so what that means is that many portfolios are benchmarked against the MSCI. So they tend to look more similar than funds that are benchmarked another index like the FTSE, for example. Okay, so I might be more interested in building up a portfolio of clients that have the non-MSCI portfolios. I might give them a fee split that's a little bit more attractive because I want to get them into my agent lending program. Withholding tax rates, we've already talked about that in jurisdiction. And of course, finally, the collateral, which we made the point on. The wider and more attractive a collateral profile it has from a borrower's perspective, the more interested an intermediary is going to be in getting that into their program, and therefore might give more favorable fee splits for that. Now, one of the issues is, of course, that different service providers provide different service levels. Clearly, securities lending is no different than anything else. So fees alone are never a great sort of decider, right? You need to understand the quality of what you're getting first, and then determine whether the fee is appropriate for that quality of service. And one of the key things that we've talked about in other videos is indemnifications. Again, not all indemnifications are created equal. They have different components to them, what they cover, what they don't cover. They have different backing in terms of whether it's capital or bank lines or insurance policies. And so they all have different risk profiles in there, and that should influence a decision by an investor to say, yeah, I feel really comfortable with this. I feel less comfortable with that. And if I feel less comfortable, then am I going to do it at all? Probably going to proceed anyway. And so the question is, would I pay the same fees? Now, look, we've got a few comments. Clive, thanks very much for coming in. Appreciate that. It's always great to hear from someone who is a great teacher themselves to give me quite a kind compliment. I'll just flash that up because I need an ego boost right now. So thanks very much for that, Clive. Much appreciated. But we've got a great question here from another LinkedIn user. So why wouldn't the asset owners form a cooperative to negotiate better rates? And have we seen that? The answer to that is, yeah, particularly in the UK local government pension funds, the local government pension schemes, they formed a series of consortia where each of the local authorities belongs to one of a buying block, a group that negotiates asset management fees, securities lending fees, those sorts of communities where they have common interests and they get better fees by aggregating into bigger scale. Of course, for other communities, though, they're competitors. One mutual fund wants to get a better deal than another mutual fund. And so by giving their competitor an advantage on a larger price, it may erode some of their own position. So it is difficult to think about that. So while there may be pockets of opportunities, like the local government pension schemes in the UK, it's not a commonplace thing, and that's for competitive purposes, right? All of these firms are competing to get investor money into their fund, not someone else's fund, and securities lending can make a difference in terms of income that way. So if you think you have an advantage, you don't really want to share that with your competitor. But look, it's a great question. Yeah, absolutely. And it wouldn't be a surprise to me if we saw some more activity result in the future in terms of combines of revenue. And it looks like I've answered your question. So thanks for that. Thanks for asking. Now, of course, disclosure would inform decision making, right? If everyone all of a sudden had to disclose the fee levels that they get from their service providers, then it would be easier to determine where you fit in that spectrum. Of course, does that then trigger a race to the bottom where the service providers say they priced it at a 75-20 split, so 75% to the investor, 25% to the service provider, and another fund gets 80-20. Does that then force the 75-20 investor to go to their agent and say, these guys got 80-20, what about me? And it becomes more of a challenge, right? So that you then just get into a potential situation where it is just about what's the lowest fee. And to me, the best kind of clients are the ones who will drive a hard bargain, but recognize that the service providers have to be able to invest in their business on a profitable basis to continue to enhance and upgrade and deliver quality solutions. So I get the point about disclosing, having some value, but I think there is a possibility that more disclosure and more public policy and information on fee splits, I think while it could improve the market, it isn't necessarily a lock that it will. Okay. But inevitably, I think we'll see more transparency, because otherwise you got money flying out the window, just like that video shows. Okay. This is where I give the pitch about the courses that we have. We've had a bunch of people actually sign up in the last couple of weeks while I'm off. Maybe I need to take more time off and more people will sign up. Who knows? But thanks to any of our newest, appreciate that. And if you're interested in learning more, either on these published courses, of course, what I never really talk about is the fact that I also do customized, bespoke, company-specific training sessions. Have been doing that for, I don't know, probably, what year is it? 2021. I've probably been doing that for 12 years now. So if you have very specific needs, let me know. We can customize courses for that as well. So to summarize, more active voting is inevitable. It's going to challenge all of the market intermediaries, be they borrowers or lenders. Active and passive investment managers are both under pressure to reveal more about how they vote. Stewardship is becoming ever more important. That will provide challenges to intermediaries. Second point is collateral. On collateral is selectivity is increasing. And when I describe barbell shaped, what I mean by that is you kind of have two camps. Most lenders that have been lending for a while, what they're trying to do is they are trying to make their collateral profiles more attractive so they can attract more business. And so they've gone, maybe they used to only take government bonds and now they take government bonds and equities. So they're moving away from that kind of middle of the road, safest, most secure collateral. And they're bunching up now with the widest community who do take a really broad range of collateral. But at the same time, I talk about this growing movement by ESG investors to be more selective on their collateral. So they're going from the middle space again, and they're going to the other end of the extreme where they will become really narrowly focused in terms of assets that they're willing to hold as collateral. So I see where in the past we've had quite a wide spectrum of investors with collateral. I see that sort of going to the two ends of the barbell, and the middle bit really being much less attractive and much less occupied in the first place. Okay. If we then go to tax is, as I say, omnipresent, and it can be an advantage or it can be a disadvantage. The key there is clarity and understanding. And the best solution for that is expert advice. And then finally, as far as fees, fee levels are generally not transparent. But again, I caution everyone, including regulators, that fee transparency would not necessarily be beneficial. Okay. Just in and of itself, I think it has as many good sides to it as it has bad sides. So that's that for, so I hope that was transparent and clear to you. Okay. If not, look, always feel free. If issues or questions arise after these, put them in the comments. I always respond to comments, maybe not on the same day. I try to get to them same day or next day. Look, if you found this helpful, please give me a like. So I'll know which videos actually work for you guys and which ones don't. Next week, again, thanks to Emil, we're going to be talking about fair distribution and how stocks get allocated or bonds get allocated for loan opportunities. And there are nuances to that as well. So that's it for another week. I appreciate you being with me. We've been on for 45 minutes almost. I have a few seconds left. So we'll do the big wrap up and we'll finish on 45 seconds. That's it from me this week. Watch for the recorded video tomorrow, Sunday, the 12th of December. Have a great Saturday. Have a great weekend. Have a great week. I hope to see you next week.